Walmart's return on assets in 2012 is 8.51%. We could calculate that by taking Walmart's net income and dividing it by assets, or we could use the DuPont identity and multiply Walmart's 2.31 asset turnover by its 3.68% profit margin and get the 8.51% return on assets. Harley-Davidson had a return on assets that was much lower in 2010. It was 1.55%. We can see it has a roughly comparable profit margin with that of Walmart, 3% each for each company, but its asset turnover is only 1/5 of that of Walmart's. It's at 0.52. It's only generating 52 cents in sales for every dollar in assets, while Walmart is generating $2.31 in sales for every asset. PP&L's return on assets for 2011 is 3.51%. It has a much higher profit margin than Walmart, but also a lower asset turnover. In 2013, Walmart generated roughly 8.4 cents in net income for every $1 in sales. Apple, on the other hand, generated roughly 17.9 cents in profit for every dollar in sales. And this is our return on assets. How much income do we earn for every dollar invested in assets? Which of the companies is more efficient at generating profits with its assets? Clearly, that would be Apple with the higher return on assets. Which company's return on assets improved every year? That would be Harley-Davidson. Its return on assets grew from 1.5% to 6.1% to 6.8% in 2013. The primary source of this improvement, we can see, was an increased or improved profit margin. Its asset turnover improved slightly, while its profit margin more than tripled from 3% in 2010 to an 11.1% or 11.2% profit margin in 2012. What happened to Walmart's return on assets between 2012 and 2013? Walmart's return on assets between 2012 and 2013 decreased from 8.51% to 8.37%. The source of the decline was a lower profit margin. The asset turnover remained constant at 2.31, but the profit margin dropped from 3.68% to 3.62%. What happened to PP&L's ROA between 2011 and 2012? Well, PP&L's ROA decreased from 3.51% to 3.5%, a slight decrease, but a decrease nonetheless. What caused the change? Well, the source of the change was a lower asset turnover. It dropped from 0.3 to 0.28 in sales for every dollar in assets, while over the same period of time, PP&L's profit margin increased from 11.7% to 12.4%. However, the improving profit margin was not enough to offset the falling asset turnover. Over the past 3 years, Apple's return on assets has decreased. What caused the change? Well, 2 factors contributed to the change. A lower profit margin, profits dropped from 23.9% down to 21.6%, and at the same time, Apple has become less efficient at generating sales with its assets. Its asset turnover dropped from 0.93 to 0.83. Recall the big increase in Apple's cash holdings and investments. These increase the asset base but don't do much to generate additional sales, so we typically will see a decrease in asset turnovers. Apple's return on assets are nearly or roughly 5 times greater than PP&L's return on assets. Does this mean that Apple is a better investment? And the answer to that question is no. While Apple has a higher return on assets, this doesn't mean it's a better investment. While the return that a company earns on its assets is important to shareholders, they're ultimately more concerned with the return they earn on their investment. And that's going to depend largely on the company's current share price. Is a share of stock in Apple or PP&L expensive, or is it a bargain? And this is captured by a company's PE ratio, or price to earnings ratio. In addition, ROA is a measure of current performance. And as an investor, you're concerned more about future performance, such as future sales growth, future cash flows, and profitability. And these are often a function of the business environment in which each company operates in. Apple and PP&L face different financial and operating risk. Arguably, we would say Apple operates in a much riskier or uncertain industry than does PP&L.